Hello, everyone out there in podcast land. Welcome back to Adventure Capital, where we not only discuss the entrepreneurial journeys and adventures with founders who have raised capital on Wefunder, but also the different resource providers and mentors helping founders along the way. Huzzah! In this interview, we chat with Max Mona, co-founder of ESG Impact, a startup building a business credit score for ESG Environmental, Social, and Governance. Before we get on with the podcast, we're required to let everyone know that anything we say here should not be interpreted as investment advice, recommendations, or soliciting investments in any company. All companies raising on Wefunder are given an equal opportunity to participate in the podcast based on the progress of their campaign. Wefunder gang, take it away.
Everyone, welcome to another episode of Adventure Capital. I'm delighted to be joined today by Max Mona, who's the founder and CEO of ESGI. Max, welcome to the podcast.
Thanks, Johnny. Thanks for having me. Really excited to be here.
And Max is also a Wefunder Venture Scout as well, which I'm stoked about. And you've done an unbelievable job of connecting us to so many really cool founders that are interested in running a community around on Wefunder. So thanks for that. Maybe you could start, Max, by giving us a quick overview of what you're building with ESGI.
Yeah, no problem. ESGI or ESG Impact, essentially what we've built is like the credit rating that businesses and funds can use to assess their business ethics and sustainability. We help companies identify, educate, and integrate ESG best practices into their operations to help them drive both positive impact and financial returns.
The first thing that makes me think of is BCorps, right? So BCorps have this label. B Lab is the company that is kind of doing this accreditation. What are they kind of a competitor to ESGI, or is it kind of a complementary kind of thing that you guys are building?
Definitely a complementary relationship. I love both Adam and I love what BCorp does. What we think of our business is like an intro to impact. The BCorp typically takes a while to get certified. It's a pretty lengthy process. What we offer companies and funds is very quick and easy. It allows them to essentially get a baseline of their own operations and then make those impactful and action next steps.
That's awesome. What's your background, man? How did you come to be launching this?
Yeah, no. So both Adam and I, as co-founders building this company, we're getting our master's in finance at Vanderbilt right now. We both have experience in private markets, myself on the venture and private equity side, and then Adam in middle market M&A. And, to give the best kind of context available, I mean, we're trying to solve a problem that we saw firsthand. I was working with a private equity fund in Nashville. We were looking at, integrating ESG best practices into not only at the fund level, but also through our portfolio. And what we were facing was very expensive ESG consulting bills and essentially just this super intrusive process that we didn't really want to sign up for. It wasn't conducive to the goal of the company. And so what we're trying to build is an automated platform that takes the ESG consultants out of it and kind of removes that human capital process to allow companies and funds to build out these processes and frameworks very quickly and efficiently.
Can you just say more about ESG consulting? So who is the client of that consulting firm? What is the work that is being done? I'm just kind of curious for you to kind of explain more about the business model or like the industry that exists today that you're kind of disrupting.
Of course. Yeah. I mean, impact is complicated. Unlike financial returns, which can be easily communicated to stakeholders, I mean, ESG has had a lot of evolving standards. And what we're starting to see with the SEC is that there's going to be some impending regulations and compliance that companies and funds have to adhere to. On ESG consulting, what we've seen is, I mean, it's time intensive, costly, and can be intrusive. But these are typically internal.
There's a fund that's like looking at making an investment in a company, and they want to do some sort of audit in the same way that you'd audit the financials of a company. The fund wants to do like an ESG audit to understand that company's footprint on the environment. And so they engage a consulting firm to kind of analyze the ESG impact of that company and then the consulting firm provides that to the fund, so that when they make their investment, they have that ESG kind of score in mind. Is that the kind of model, the use case we're talking about here?
Definitely. I think one of the things that I've seen firsthand is, ESG consultants have done a wide array of jobs, from due diligence of prospective investments, like you just touched on, but also a lot of like portfolio support with existing companies and helping them track emissions, or if you're like
if I'm a fund, I have a portfolio of companies on an ongoing basis, what's the environmental impact and maybe trends of my portfolio companies overall?
Exactly. But these processes are expensive and they're time intensive. Typically, these are hundreds or thousands of emails back and forth. They're PowerPoints typically made by like an intern. I mean, it's just not an efficient practice.
Are like not excited about the ESG consultants coming into their business, and I've got to track down all these numbers and send this Excel file and have a bunch of back and forth with these ESG consultants to them.
Exactly. Yeah. Founders are trying to build a business. They only have so much time. And so
at Kiva, running the Kiva US program, I was running that for 7 years. And, one of the challenges of raising nonprofit capital is that it always comes with strings attached and kind of reporting requirements. And so we just have these really onerous reporting requirements. It's like, it's $100,000 grant, and I've got to do all of this kind of tracking. And by the way, not just for Kiva as a nonprofit, but also for our clients. So then we got to survey all these small business owners that we're making loans to and take their time as well as our time. And it's I want to dedicate those resources to growing the business, as you say.
Definitely. You might have cut out there for a few seconds, but I caught the gist of what you were talking about in terms of reporting. I mean, looks like we might have had a little technical difficulties there.
Sorry about that, man.
Can you hear me okay?
Yeah. Can you hear me, Max?
I can hear you. Can you hear me okay?
Yeah, I can hear you. I really hope the recording just kind of picked up again. I didn't touch it, so I hope when the internet cut off, my Wi-Fi was bad. I just shifted to my phone. I hope that when the Wi-Fi cut out, the recording kind of stopped, but then restarted again. So
I hope so.
Yeah. I think the question that I was going to get into was, I was talking about the Kiva thing. So let me just kind of say that point again.
Mm-hmm. Yeah,
I remember when I was at Kiva, we would raise these grants from foundations and companies sometimes, and they would just come with these really onerous reporting requirements, and it would take up a bunch of our time. And it's like $100,000 grant, and then not just our time, but also our clients' time, the small business owners that we were serving. We had to go to them with surveys. They had to fill in the surveys, and it was just I really, as you say, would love to be dedicating these resources towards growing the business. So that's kind of the current model, and then how you guys is just much kind of lighter touch, or how are you solving that problem?
Definitely. I think that the big pain point that we're solving is that we don't think business ethics are transactional. We think they grow and change alongside your business and your operations. And so a big way that we've established this is that ESG is different for companies of all different sizes. I mean, if you're a seed stage or a Series A level company, your responsibilities are much lower than that of a company that's maybe looking towards an IPO. How we've been able to do this is by creating an automated solution that really just takes self-reporting assessments. And so it's not meant to be this transactional piece where you're constantly communicating and working with consultants. It's no back and forth. It's a process that takes a few hours. And so we've taken a lot of the big pain points and stress that we've seen firsthand in our experience in ESG and have been able to really try and find and deliver value that fits the schedule of both fund managers and founders.
And so how is the company doing? I think we first connected on it a couple of months ago, and then since then it seems like you've done you've made like a ton of progress. It seems like this is something that people want.
Yeah, it's been really validating in the past few weeks. I mean, I can't say enough great things about my co-founder, Adam. He has been, spent so much time developing this product that essentially sells itself. We've been picking up clients for our beta that we recently launched, our largest being a $1.2 billion venture capital fund, focusing mostly on biotech in New York City. We recently won the SEC pitch competition.
1.2 million was that, Max? Oh no, 1.2 billion with a B. Awesome. That's amazing. That's so cool.
It's been really cool. I mean, last week I'd say was our biggest point of validation for Adam and I personally, where we were selected to represent Vanderbilt as their like chosen startup for the SEC pitch competition. We traveled down to the University of South Carolina. We competed against startups, some of which that have raised millions of dollars in grant funding, or founders with prior exits from these other 13 SEC schools. And we won first place. And so it was a great opportunity for us to really like, not only, highlight our progress of the business and how it's been moving, but to see that kind of alignment with the 10 different judges that we pitched during that day, that gauntlet essentially that they put us through. And
that's
so,
really
yeah,
cool.
I mean, things,
and by the way,
things,
it's funny to me that when you said SEC, this is partly me growing up in the UK and not growing up in, in college football, but also partly like working for Wefunder in financial regulation industry for, the last 4 years. That when you said the SEC, I was not thinking of the Southeastern Conference.
Yeah, we went to the Securities and Exchange Commission pitch competition that they have.
That'd be cool.
That's funny.
We'll can participate in that SEC pitch competition sometime.
Oh, that's funny. But it's been fun the past few months, and now that we're graduating from Vanderbilt in the next few weeks, and things are really looking full scope, Adam and I are excited to be taking this full time and really, putting our heart and soul into this business to see it grow.
I love it. You're obviously tapping into a trend in the market. There's some Mark Andreessen quote that I forget, but it talks about, basically markets rule, right? Like you can have an amazing founder. If they're in a tough market, they're going to struggle. But if the market is kind of, pulling you along, then that's super powerful. Like, and there are big macro trends over the last, decade or so, more in the direction of, fund managers and kind of people thinking about, broader impact than kind of single bottom line and how they're constructing portfolios and making investments. Can you kind of talk to some of those trends? There's probably stats like, I don't know, like X percentage of, the Fortune 500 are kind of thinking about ESG or something like that, or are there any kind of macro trends that you can kind of help illuminate?
Of course. I think, the big pivotal number that we always go back to, and this is, I think, by Bloomberg, is that ESG assets under management are expected to reach $53 trillion with the T by 2025. And so what we're seeing, whether it's in public markets, private markets, is that companies are starting to face pressure essentially from the top down to integrate ESG into their operations. Our whole focus.
What does that mean, man? When you say 53 trillion in ESG assets, what does it mean to be an ESG asset?
I think what it means to be an ESG asset is it comes from the investor and how they're, essentially allocating money. These typically like LPs or hedge funds, however you want to categorize it, with asset managers, have started to integrate this focus or necessity of impact as well as profitability into these companies. For so long, like you talked about, there's just been this single line of how profitable is a company, how fast are they growing, and that's really been the overall discussion of if companies want to invest. Now we're looking at opportunities where companies may or may not have validity in terms of what their ESG and impact is, where you might not necessarily pick, a full portfolio of ESG companies and expect to outperform the market. But when you pick the right companies that have ESG integration and are doing it properly, you're going to see a portfolio that is significantly more de-risked to macroeconomic trends. And you could see the ones that start to outperform the market as a whole. And so I'd say that, ESG, it's a little broad, but it can mean a whole bunch of things for different companies and different funds. I think that it's partial our job, and especially the SEC's job with this impending framework, to try and find a unified approach to categorizing and quantifying it.
Yeah, that's what I'm trying to get at. I thought about this a lot when I was at Kiva, where it's like, what does impact mean, right? And, I don't know, I'm not going to name a company, right? But take an evil company, right? Let's call it Evil Inc. If Evil Inc. does some kind of report or highlights, hey, look, we're thinking about ESG because, we gave away a tiny fraction of the profits that we, accrued through these really nefarious, corrupt practices. But look, we gave this mini grant to this local nonprofit. So, hey, we checked this ESG box. How do you, I'm just kind of, who draws that line? BCorp have this, or B Lab has this BCorp badge, right? You guys have a credit score, which is an interesting approach. It sounds like that's almost like a sliding scale, right, or a spectrum. I don't know how that works. So, I imagine, as you say, credit score. So imagine it's there's a score out of 100 or a rating, or
exactly
there's a rating on bonds. I'd be curious to learn more about that. But I just, you know what I mean? Is there a cutoff point where it's this company is black and white, not ESG for this reason, which I don't know what their reason is? Or is it more of a sliding scale?
What you're touching on is the problem that companies and asset managers are facing with ESG all across the world. The way that ESGI thinks about this is we can't be the gatekeepers of what's right and wrong. That's not our job. What we can say is we're taking best practices as determined in every sector and every industry, and then essentially creating a framework that's customized to what a company's operations are. So instead of throwing this huge blanket of ESG onto a company and saying, hey, this is what your responsibilities are, we're trying to find a more targeted approach. You talk about Evil Inc. Well, it's twofold. One, you could be a company that might have, an emissions or waste related product, but could be really great on the ESG front in terms of how they're working with local communities, hiring diverse talent, et cetera. Or you could deal with the opposite. You could have, really good Inc. who has a great consumer friendly product. But as we've seen time and time again, that doesn't necessarily mean that they're ESG. We've seen multiple reports of publicly traded companies where they have a great consumer facing product that's sustainably made, but then you'll find out that their supply chain is riddled with corruption, and or they have gender discrimination or race discrimination lawsuits in terms of hiring practices. And so I think what ESG really means, in the way that we like to say it, we move away from what the primary product and services typically are, and we look at the internal and external operations and how they affect their stakeholders. And I think when you look at it both quantitatively in terms of what an impact rating or a credit score could be, but then also qualitatively, that's when you could start to make a real analysis. But at the end of the day, because there's no really centralized framework that everyone's working off of, everyone's just trying to figure out, and they're making these decisions on their own. I mean, there's a lot of, essentially, from what I've seen, winging it in terms of how investors are making decisions. And so until there's a unified framework from the SEC, until there's a globally adopted framework, it's going to continue on this trend of people want to make as informed decisions as possible. It's just how you get there.
Yeah, and say more about that framework in the future here, because here you are talking about the Securities and Exchange Commission, I believe. I don't think the Southeastern Conference is rolling out rules around, how we think about ESG. So say more about what that coming guidance and rules is going to look like, and kind of what the future holds for the sector. I mean, obviously, more and more assets under management are going to kind of have a lens an eye towards ESG, more and more companies are going to be cognizant of their impact, which is awesome, I think. But yeah, where's the sector heading over the next few years?
So I would say there's like three things that I found really important as far as SEC and compliance over the past year or two. Back in March of, I believe, 2021, the SEC created a climate and environmental, social and governance, so ESG task force, with really trying to research where they could add as much value to these companies while also kind of staying focused on what impact could mean. On March 17th of this year, so a few weeks ago, there was a proposed rule. I think it was like 550 pages of legislation and documents, something around there, that essentially is requiring SEC registered companies to include certain climate related disclosures in their statements and reports, including climate related risks as well. And so I think that the market is starting as a whole looking at, the E in ESG, but everything else is going to shortly follow. I mean, if you look at the statistics, inflows of ESG related money has been skyrocketing over the past 3 or 4 years, where it seems like it's like doubling, tripling, quadrupling every single year in terms of investor inflows into impact focused, companies, funds, right, ETFs, et cetera. There's just so much interest. And I think, honestly, it's generational. I mean, all of the people that I talk to that are my age typically have this value alignment where they want to invest in companies that share that same sort of impact focus that they do. Consumers are typically looking and they want to know where their products come from. Right. I think it starts, with this big rise in retail investors over the past few years. And I think it kind of even, looks into what Wefunder does. People care about the companies that they're investing in and they want to know about them. And so I think this is just a logical next step in defining what companies do with their impact.
Yeah, and I've been given this example recently where I try to analogize it to what we're building at Wefunder with community rounds, where it's like the organic food movement, or I don't know if movement's the right word, but like if you look at the CAGR of organic food over the last 2 decades, let's say, the growth rate of organic food as a sector is way higher than the growth rate of non-organic food. And yes, that's organic food is good for the environment, but I think the reason it's been growing so fast is because people think that it is good for their body, right? And it's good for them kind of narrowly and selfishly. I think the same thing with community rounds at Wefunder. It's like, we think it's a good thing for society if, a startup like the next Uber, the next Airbnb opens up its ownership to ordinary people, broad swathe of society, their customers and community, as well as rich people, VCs, etc. So that's good for society, but also we think it's going to be good for the company because those community members and customers will now be more passionate brand evangelists and want to help those founders, right? And so that's going to accelerate their growth. And so the growth of Wefunder and community rounds is kind of going to be driven by, this is in the narrow self-interest of the founder. Oh, and by the way, the cool thing is it has these benefits for society because we're sharing the wealth created by capitalism more broadly. And so I suspect that that's kind of what is going to drive the adoption and continue to drive the growth of ESG as a kind of, I don't know if asset class is the right word, but more and more kind of higher and higher percentage of assets under management being kind of viewed through this ESG lens, because of course we think that's good for society at large. But as you were saying, you are at risk, given kind of shifting consumer trends, given, people increasingly care about this stuff and social media shines a spotlight on it. Volkswagen's probably damaged by the scandal that they had, right, around emissions a few years ago. And so unless you are kind of tackling these issues, you it may be bad for your business. And if it's in your narrow kind of, is not in your narrow self-interest, then, okay, that's really going to drive the behavior. So yeah, as you say, these kind of shifting consumer trends are probably, I would argue, kind of the engine that's driving these kind of macro shifts.
I couldn't agree with you more. I mean, what we saw firsthand, it's funny you say this. I actually just walked out of an M&A class here at Owen at Vanderbilt, where we're talking about a recent acquisition that Microsoft did with Activision, which was like $75 billion, some huge amount of money. But the whole reason this acquisition took place is because if you look at the ESG and Activision, I mean, they've had company walkouts. There's been such a poor history of like sexual misconduct claims. I mean, hundreds of allegations that have just been swept under the rug. Now, you may sit here and say, hey, well, I don't see company culture on a balance sheet. But when all of your employees are walking out and nothing's being done for weeks at a time, that affects your revenue. That affects, how you are able to get products out. I mean, it's affecting companies quantitatively by not fixing what they can do, building the right foundation and being able to go from it. I mean, one statistic, I know I talked a little bit earlier about the assets under management. One thing that we always say that is really, I think eye-opening to companies, especially as they continue through their life cycle, is that, private equity partners, as they're making investments, ESG is great in the eyes that there is a premium to really awesome ESG companies and how they can raise more money or exit at a higher multiple. But people also don't talk about the ESG risks. And so after ESG due diligence, oftentimes, and I believe it's like 54%, based on a report that we were reading, that companies will have a reduced capital raise and or exit valuation because of poor ESG. And so it's becoming now as important as ever to not only have ESG for the good, but also to mitigate the bad.
How are you monetizing? What's the ESG impact business model? You're charging fund managers for reports on their portfolio companies or potential investment targets, or are kind of individual companies paying you so they can get a scorecard? So because that's going to help them raise capital.
So we're all over the place right now. We're in beta. And so obviously things are a little fluid, but the way that we've identified and brought on our early customers, we're at about 120 right now, funds and companies that have signed on, is that we charge a flat rate to the company and the fund. It's about $500 a year. Typically, we've had no issues with companies and funds being able to pay this. And for us,
increase your price, man.
Oh yeah, of course we got to increase the price. But our whole point right now is
I was like the kind of, hey, lower the price to get a bunch of users in the door, get their feedback, and then we can increase the price later. That's my take.
Yeah, I mean, I agree. I think right now, especially in beta, it's not about revenue for us. It's about what our product actually is doing for these customers. And so if we can bring on, 200, 300 firms and actually solve their problems, I mean, that'll open up the doors for the next few years about how we'll run the business. But it's just about, I want people to get on ESGI and say they like certain features and say they don't like others. And that will allow us to kind of build the business and move forward.
That's awesome. Any early lessons from the first users around, this is the killer product feature we got to build next?
I think the biggest lesson for me, being sort of the externally facing piece of our company with Adam really focusing on product development, is how hard it is to sell something. And what you actually learn in realizing what it takes to identify pain points. Obviously, we're a bunch of really passionate grad students who have worked our butts off over the past 9 months to make this happen. But there's a lot of lessons that we've learned, I think, in just like how we communicate about the business and the story and the narrative that we build along too.
And hot, man, you got 120 customers already, and you're like part-time from business school, like in beta. They're like, yeah, I feel like most people would kill to have those problems.
I think that there's been a lot of no's along the way too, a ton of no's. But I think for us, it's been, not only on the rating side, but and part of this is even taking from Wefunder. I mean, you guys build a community of people that want to see which startups are raising next for a community round. Like these people, including myself being a scout, like I'm always checking the site to see which companies are raising. And we want to build that same sort of mentality with ESGI, where, if I'm a company that just raised a seed round and I have, a great impact rating, I've been working on this, it's a priority, I want to be able to connect with other VC funds on our platform that might share that same sentiment. And so what we're currently testing out and working on integrating is this like matchmaking tool essentially that says like, hey, if data security and customer privacy are key, focus points for ESGI specifically based on our materiality assessment that we take, well, we want to be focused with VCs that might share that same expertise, because it ultimately helps us, create and match with value aligned investors, which at the end of the day, as a startup, is I think all you're looking for. Because there's too many horror stories that I think we've both heard about companies not lining up with the right investors, and then their business just has to go through so many unnecessary hurdles.
Yeah. You mentioned the community round concept just then. It's an awesome week for us. Team Wefunder rolled out communityround.com on Tuesday, and trying to rebrand this industry away from equity crowdfunding towards running a community round. What's you're a venture scout for us. What's your kind of take on this community round concept?
Oh, I love it. I am the biggest fan of Wefunder. I think that, you touched on it a little earlier, but democratizing access to investing in startups is something that I want everyone to kind of know about. I think that in the conversations that I have as a venture scout with startups, a lot of the founders that I talk to don't even know that they have this option. They don't even know that they can essentially pick their, evangelist early adopters in the form of their customers and be able to raise from them. And oftentimes when I talk to them about the pros of what a community round looks like, they're blown away. I mean, there's just so much value alignment that I see as early startups tend to really focus on those, earliest adopters and how they build, that I think that Wefunder is just setting themselves up to kind of lead this charge towards what a community round looks like. And I'm hoping, I know you and I both are hoping, and I've seen your tweets about it, that, there's no more talk of crowdfunding or equity. That's pushed out the window. I think the community round narrative is such a better way to frame it. And I'm hoping that that's really where the adoption starts.
Love it, man. Couple of last questions for you. Firstly, one company that you would love to see open up a community round on Wefunder, one company that, you might petition that you would love to personally invest in?
Oof. Now that's a great question. And maybe this is a cop-out answer, but I can guarantee you that when ESGI raises some money, we want to do so on Wefunder. I think that my perspective as a venture scout has allowed me to not only see Wefunder from an external point of view, but also kind of when you're internalized, when you're working alongside, you and the rest of the team, you kind of see how you see how everything's made, you see how it's built. And there's just so much value alignment that when it comes that time for ESGI to raise money, hopefully in the next few months, as we progress through onboarding customers, we want to be able to have that access where customers, anyone interested can essentially have that access to do so.
Love it. What a great answer. One company you want to see do a community round of Wefunder. My company. All right. Lastly, one piece of advice for another founder who's, just rolled out their beta app, working on it, 9 months into the journey. One piece of advice for a fellow founder.
I would say, the best advice that I've ever gotten to me that has changed the way that I've built ESGI, but also just, approached my relationships both professionally and personally, is to always be intentional. I've taken that sort of approach into how I've built the business with Adam, but also, how I engage at Vanderbilt in grad school and just everything. And I think, being intentional, whether it's in how you're responding to emails or how you're communicating with investors or your customers, I think typically ends up leading towards a positive reaction and a memorable connection, because not only do you want people to obviously engage and have those positive experiences, but you want them to, 6 months from now say, oh yeah, I remember working with Max. He was great. I thought he solved our problems. I thought, he took the time to really get to know us. And so I would say, just be intentional and keep that sort of methodology going as you continue to build the business.
Love it. What a great note to end on. I would also say, I remember going for lunch with you and looking at your calendar on your phone, and it was like, whoa, your calendar is even busier than mine. So I feel like you've definitely, there's a hustle to what you're doing. It's like very, very evident and impressive. And I'm sure those 120 customers that you guys have signed up is, a lot to do with the super intense kind of ethic that you're bringing to this. And yeah, it's really impressive what you guys are building and the progress you've made. And yeah, would love to work together down the line for a community round for ESGI. And this has been a really, really fun conversation. Obviously, Wefunder is a PBC and a BCorp. This kind of, thing, kind of, social enterprise, ESG, impact investing. Like my background's at Kiva in the nonprofit sector before Wefunder, so this stuff is, kind of near and dear to our hearts. And it's been a really, really interesting conversation. Very, very cool to see what you're building, and look forward to seeing what's next, man. Thanks for coming on the pod.
Thank you so much, Jonny. I appreciate it.
Cheers, Max. Bye.
Thank you for tuning into another episode of Adventure Capital. I hope you laughed, took notes, shed a tear, and most importantly, feel ready to go off on your own adventure. And remember, whenever you're ready, Wefunder's here to help. Be sure to like and leave a review, gang.